Hey, this is Danielle, and today I'm going to be talking about Lamb Research, which has an earnings report coming up, and I think a pretty good overnight earnings trade setup as well. So, let me just start off by looking at the previous overnight moves that this stock has seen. What you can see here is that they've had overnight gaps between, let's call it, uh, about 5% and then downwards into the 0.3% range. So, a bit of volatility, but nothing too crazy. It's not like we have 10 or 15% gaps here. Now, if you look at the average gap, what you'll see is that the average gap is closer to about 1.3%. And you can also see that about half the time the gaps are up and about half the time the gaps are down. So when you have a situation with a stock like this where you can see it's about 50-50 on those overnight moves up and down, you can also see that the top end of the range is about 5%. And then when you look at the market maker move and you see, okay, the market maker moves $33. So what percent is that? $33 on a $650 stock is going to equate to about 5%. So what that means is that the market makers are pricing in an overnight move that's at the very top of the range for this stock. And you can see that the implied volatility has continued to trend higher, well, really pretty much the whole quarter. There was a little dip right here, but it's trended higher the whole quarter and it's up at highs right before this earnings report. So, since it's pricing in a move around the top end of the range, and since the ticker is trading right at a key psychological value that's also in the middle of this range, that one looks like a good one for an overnight earnings trade to me. So, how would you set it up? Well, you'd go to your options chain. And mind you, this ticker is not going to be reporting earnings until the 18th after market Central Standard Time at about 4 o'clock. So I will not be entering this trade right now, but I would be entering it on the 18th before market close. So let's just price it out and pretend as though this is the moment in time and see what that would look like. Now, there's a $33 expected range, trading right at 650. So let's see. What if we did 650, 680, 650, 620? So looking at that, what you're going to have here is you're going to get a $23 credit and you have a risk of $30. So, what that leaves you with is a max loss potential of $668 per contract with a max profit potential of $2,332 per contract. Now, when you're looking at the risk to reward, this is exactly the kind of risk to reward that I want to see, because when you have those kind of odds, it really puts the odds in your favor. Now, you would never get the max profit unless you held the trade all the way until market close on Friday and it stayed right at 650, but I'm not going for the max profit. I'm just going for overnight vol crush. You could widen it out a little bit more, especially if you wanted a higher and lower break even price. In this instance, widening it out another $10 is going to give you a larger risk, but it is also going to move your break even prices a little bit further out. So I really like either one of these trade ideas. I think it makes sense. The idea here that I would do is I would basically just sell it right before earnings. And then you can see the way that that volatility is normally crushed on that earnings report. And I would just look at buying it back the next day. Now, inevitably, people will say, okay, well, what if you're wrong? What if this time it moves 10%? Well, that's the time that you're wrong. So if you look at the last 8 quarters and you say, if I would have used this strategy, the last 8 quarters in a row, how many times would I have made money? Well, probably would have lost money last quarter. The quarter before that, depends how you manage your trade. but the rest of these quarters would have been just fine and in the green. So certainly there are going to be quarters where it will fly outside of the range. If that happens, you have your max risk that you already predefined when you got into the trade, and you end up buying back the condor for more than you sold it for a loss. But you're never in a situation where you have outsized risk because you're using a risk defined strategy by selling calls and selling puts. And that, my friends, is how you trade overnight volatility in the options market. So, if you want to learn more about my earning strategies, I'm going to be having a webinar on Wednesday at 7 o'clock. You can go to simplertrading.com/clockwork. Clockwork right there. And you can sign up to learn more. I'll be talking all about my tool, how I identify overnight earnings trades, and more. I look forward to seeing you there.
Hey traders, thanks for watching this video. If you want to make sure that you get all of our free trading content, make sure you hit subscribe and also give us a like and comment down below. If you want to learn more about us and if you want to join us for live trading in real markets with real money, make sure you go to simplertrading.com where you can join us for more info. Thank you very much and have a great day.